Okay, so the premium tax credit, this is related to the Affordable Care Act, otherwise known as Obamacare. What the Affordable Care Act did was it did a lot of things, but one of the things that it did was it provided a credit for eligible individuals to purchase health insurance. Now they have to purchase that health insurance through what's called the Healthcare Marketplace, which is an agency that runs this website. A federal agency runs a website where people go on and they purchase health insurance. But your premiums are based upon a lot of different factors. They're based upon your income, they're based upon the number of people in your household, and so on and so forth. So there are two ways that individuals who qualify, so you may qualify to purchase the insurance from the Healthcare Marketplace, but not qualify for the premium tax credit. Like you might not get a tax credit for it. You might have to just pay out of pocket for that health insurance. Most people who purchase their health care though through the marketplace will qualify for a certain amount of premium tax credit. And what that does is it reduces the amount of the premiums down to zero in some cases. So if an individual though is eligible for health insurance through their employer or through Medicare or through Medicaid, they cannot use this health plan. They cannot get a premium tax credit for it because they're already eligible for other subsidized health insurance. But if it's purchased through the marketplace, then eligible individuals may be able to claim a tax credit. Now there are two different ways to claim that tax credit. They can do it by just waiting until the end of the tax year and claiming the tax credit on their taxes. Like they pay 100% of their health insurance premium every month, and they don't get a credit. They don't get to reduce that premium, and then they get a credit at the end of the year. That was to help them pay for that, essentially. Or, just like with that advanced earned income credit that I talked about, people can apply that credit throughout the year as a reduction in premium. So, for example, let's say that you bought insurance. So this is health insurance. And for the year, it was $12,000 in premiums. But you were eligible for a premium tax credit of $6,000. Now, like I said, there are two ways that you could do this. You could, at tax time, so April 15th, claim that credit from your on your taxes, and you get a $6,000 credit against your other taxes. Or you can apply that throughout the year. So your monthly premiums were $1,000, and then this is applied monthly. So now your premiums are $500. So you got that credit through a reduction in your health insurance premiums. Well, like I said, the health insurance credit, the credit that you get on that health insurance is based upon your income, and it's based upon your family size and your marital status and all sorts of different factors that change throughout the year. When you're deciding whether or not you're going to apply it or wait until the end of the year, you buy it at the beginning of the year for the next year. So like, actually it's for right now, I should say at the end of the year for next year. Like right now, I think the deadline is like November 30th, that you can go on the marketplace and pick out a plan, and then it'll start January 1st. But what you're doing in November is you are looking at your crystal ball and determining what your income is going to be for next year, and what your family size is going to be for next year, and what your living situation is going to be for next year, and where you're going to be living. Even the state that you live in makes a difference. Okay? Those things change, right? So if you apply this on a monthly basis, it could be at the end of next year, or when you do your taxes for next year, you look at this and you're like, well, crud, I didn't qualify for $6,000. I qualified for $4,000. If you applied that $6,000 every month, though, now you're going to have to pay back that $2,000 difference. Or it could be, gosh, I qualified for $8,000. And then you're gonna get an additional amount in that, in your taxes. So there's a reconciliation done between how much you should have received and how much you actually received. The premium tax credit, like I said, that is a credit against the premiums that you pay on that health insurance, but it's not just any health insurance. It has to be purchased through the healthcare marketplace. So to receive it, you have to have household income between 100% and 400% of the federal poverty level. Federal poverty level is based upon number of people in the household, right? So, but 400%, if you've got 4 people in your household, I think that's 400% of it's about $100,000. So, but that is just to determine whether or not you qualify for the credit itself. You can still buy the insurance as long as you're eligible to do that. Let's see, for 2021, 2022, the 400%, oh, I did not know that, for upper limit has been eliminated. Taxpayer must also be ineligible for coverage through an employer or government plan. Like I said, you can't get it through your employer or through Medicare, Medicaid. Taxpayers with income less than 100% are generally eligible for Medicaid. So that's why it's between 100% and 400%. If you're under 100%, you should be receiving Medicaid. So again, they can choose to apply the credit toward the premium, or you can receive it when you file your tax return. Let's see. So the amount of the credit is whichever is less. The premium for the insurance obtained from the marketplace, or the premium for the applicable second lowest cost silver plan. See, they put these things. The plans they put together, they were like metal colors. So like the platinum one was the really expensive primo one, and the gold one was the next, and then silver was that, and then bronze, I don't know, plastic, who knows what they all are. But that's why they say this second lowest cost silver plan, that's what they're referring to, is different levels of coverage. Minus the taxpayer's contribution amount. So there is a table here to calculate the monthly contribution amount, the amount that the taxpayer is expected to contribute. So the difference between the premium and the amount that the taxpayer is expected to contribute would be the credit, right? Determined with reference to this table. Let's see. Okay, so Appendix B has a table. These are the federal poverty levels. So if you got 8 people in your household, you multiply that by 4, and that's your limit. So that's what, $160,000, $170,000, close, 180, almost, not 180. But anyway, so let's take a look at that.
So if you have 10 people, so you want to
Yeah, it stops at 8. I think it stops at 8. We don't do big families in this country anymore. Okay, so Shanti is married with one dependent. I've got to look up the table in order to do this. Shanti is married with one dependent and a household size of 3. Her household income is $59,370. This household income is 273% of the federal poverty level for a household size of 3. So we would take the household divided by, what is this, federal, the 21,960 here, 3, 270%, and then you take that 270% and apply it to the table, which I'm going to show you in a second here, 0.0480, and then you use that to calculate what the premium credit is. So let's take a look at it. Oh, here's a full example. So Gordon is single with no dependency, enrolled, qualified health care plan, annual premium is $5,000. Silver plan premium is $5,200. His household income was $29,900, which is 234% of the federal poverty level. That's 232%. They messed up something there. 12,880? Yeah, 12,880. They didn't change this, they didn't change that either, the 234%. Applicable figure using the table is 0.0328, therefore his contribution amount is equal to 981, which is household income of 29,900 multiplied by this 0.0328. Let's take a look at that table that I keep alluding to. See it? Okay, so you divide, let's see what we so they've already divided it on that table. 270, okay, so we divide the income by what the federal poverty level is here to get our percentage, and then we use the table to apply the percentage. So that one was 270, and this was 0.048. Then we multiply this number here multiply that number, so the 0.0480 by the household income, 59,370. Well, we'll use this example. So his was 328. So his premium tax credit is gonna be whichever is less, his premium, or this minus his contribution. So we get the 981 by taking the 0.0328 times his 29,900, which is his household income. Okay, so that's how we get the $981. So then we're gonna compare whichever is less. So his premium of 5,000 or this silver plan cost of 5,000 minus that 900, where'd it go? That $981, so 4219. So he's gonna get whatever is less of those two is going to be his credit. Now, you can tell, so household income 29,900, he calculated that in November the year before. What are the chances that's gonna be exactly what it turns out to be? Pretty slim, right? Maybe he gets a raise, or maybe he loses his job and it's different, but this credit here is based on that amount. So when we do our taxes the next year, we have to reconcile those amounts. Again, it's based on expected household income and expected family size. Now, you do have the opportunity to go in during the year if something changes and make adjustments to it, but still, it's an estimate. If actual income is less than expected, taxpayer will receive an additional credit. If the family size is larger than expected, you get a credit. If it's smaller or you make more money, you're gonna owe additional tax. Let's see. Again, so there's other credits as well. Other credits as assigned. Any questions?